Hi everyone, this is Keith from Investment Modes. Sorry I took some time off from recording this video podcast because I think it's a couple of reasons. That one of the reasons is I think I was working on this project at work and I don't want to be too distracted about it. And that's one of the reasons. But I think the main reason was because I got a 4K TV as a monitor, and I thought that I can do recording and work both on this big ass TV. But apparently it is quite cumbersome to do everything within like one monitor screen. So fortunately, I managed to get myself a smaller monitor, smaller 24-inch monitor. So this is what you're seeing over here, a smaller recording. So I think let me ease slowly into this because I haven't been recording for a while. And today what we're gonna talk about is I think building on to the topic about getting income for your financial independence. And I think in the past we talked about the safe withdrawal rate and how do we craft a plan from accumulation to spending down. And I think in one of the more recent video I explained why a lot of these off-the-shelf products, whether it's a retirement income plan or whether you're buying individual stocks forming a certain portfolio, they are not the be-all end-all solutions to getting income. So let's build on to this one. And I think one of the questions that we get quite often is that if let's say we do see some prospects or even some readers coming to us with a very big focus on funds that provides dividend distributions or cash flow payouts. And I think why they prefer funds like that is for good reasons, because in their mind, without this income, they don't see a way out for them to actually get income. That together with the reasons that they know that they can sell part of a certain fund that doesn't pay a dividends to get income, but they're a little bit apprehensive about this, like whether that sounds dangerous, because if you sell the units, then you have less units, and you have less units, wouldn't your money not be able to last as long? And today in this video we're gonna discuss a little bit about that. So we're gonna discuss like that you can actually generate an income stream from these funds that does not directly pays a payout. When we say directly pays a payout, is like you go into this product, sometimes they are advertising brochure, they will say that like this retirement income plan, there is a certain cashback to it. Cashback means that the plan itself builds in this mechanism to actually deposit this money into your bank account, which means that you don't have to do something to actually sell it. Like there are more funds like this, or that even your unit trust out there, they will pay you the dividends into your bank account itself. But what if there are these funds that don't have this mechanism? So what can you do about it? Okay, so let's jump into it. Okay, so again, we go back to this picture. What do we want to achieve, right? The goal for many people is to have this residual or passive income stream so that they can spend down. Probably over here lah, you spend some time to accumulate to have enough, and then over here, let me move my face a bit lah. My face is a little bit big over here. Yeah, so you take some time to actually you want the money to last for a period of time before you pass away. So having these kind of funds that provides dividends, they sound good, and you tend to gravitate towards that because if you have a fund that doesn't pay dividends or distributions in any ways, right, that don't seem to be very workable. But we can see in a few slides later in some of the evidence that's not the case. There's going to be a lot of things out there that doesn't pays a dividend. So what funds don't distribute dividends directly? Okay, so there are some certain funds, right, that they say that they are accumulating share class. If you're familiar with, I think, investing in London or those Europe listed exchange traded funds, or even some of the unit trusts, right, they have two different classes: distributing share class or accumulating share class. They are the same funds, but they have different classes. One class, distributing, will actually pay out dividend. Accumulating will actually they will accumulate the dividend, reinvest the dividends inside. So there are funds like that, or there are funds with underlying that does not pay out large dividends, which means that this could be, let's say, your IWDA, which is iShares MSCI Core World ETF. The dividends tend to be quite low, like about 1% plus, and you will think that because it's 1%, it's not enough for your needs, and so this will look quite underwhelming to you. And thirdly, you have your boutique funds, like some of the people are quite enamored or taken in by certain nice stories that they were sold that, hey, these funds can do a lot of magic there, or the returns are pretty good. So usually these funds, right, some funds do pay out distributions, but most funds, they don't pay out distributions. Why? Because they deem that to them what is important is actually generating the returns. They would rather leave the distribution part to you. And lastly, right, it is your obnoxious personal fund. So what do we mean by that? Now, if we go back to this picture, right, while you're accumulating, right, you can imagine that you are an individual stock investor or you're dividend investors. You're forming your own dividend portfolio. The question is, are you spending down that dividends? I don't think so for a start, right? Because the dividends don't amount to much, then you're accumulating it. So you picture yourself as a fund manager managing the fund on your own, right? And you're not paying out the dividend. It's just like a fund manager not paying out dividends. And it's a good question for yourself, like whether if you look at yourself managing this fund as a third party, right, would you feel less attracted to your own personal fund? So that's a good question to think about. So usually these are what are some of the things out there that don't automatically pay out an income. Now the question is, why don't these funds distribute dividends? I think one of the big reasons I feel is that these funds, or they are portfolio managers. Portfolio managers, they will prefer to focus where their expertise are on, which is to generate total returns. And when we say total returns, which we mean that trying to get capital gains, and as well as they're going to get dividends. If they're investing in bonds or equities, bonds throw out coupons semi-annually, and if you buy a lot of stocks, you're going to get dividends as well, but they don't pay out, or they don't overly focus on that. And so that's one of the reasons. And I feel that one of the big reasons is because like if they want to pay out dividends, right, they will have to think about what's the policy and why do they have a certain policy like that. But in general, I think most of the funds out there, the retail funds out there, they have many different share class, and some of the share class do pay out dividends. So there are varieties for you to choose from, which means that they do understand that some people are in the accumulation phase and some people are in distribution phase, and they need the income itself. But the important thing for you to take note of is that the underlying fund is the same. If you buy a PIMCO GIS fund, right, there's going to be two different share class, both that accumulates or accumulates, right, or they distribute. So if you look at this list over here, right, I listed out some of the exchange traded funds that is more usage based, but also like what I just talked about, the PIMCO GIS income fund itself. So for these ETFs and these funds, they both have distributing and accumulating share class. So what you see under the distributing column over here, right? These are the ticker symbols. You can just Google them up. These ticker symbols. These are the funds that will pay out the dividends, and these are the similar. This is a similar fund, but this class, right, don't pay out the dividend itself. So PIMCO GIS income quite popular among them. You can see that there's two different class to it. But it seems that the ISIN numbers is the same. Probably I pasted them wrongly there. I think one of them it should be slightly different. But trust me on this. I think PIMCO GIS, they have many different class, including different currency class to it. So it does that mean that if let's say this fund, right, they don't distribute dividends, then you cannot get income from it? I think far from that. You could always let's say you own like about 1 million or 500K of this, right? You just sell part of it, right, and then you can get cash flow out of it. But I think your worry is that if I do it, right, can I do it in a very responsible manner so that my income can continue? I think that's the bigger problem. You would rather the fund manager do it for you. So, but let's focus on like how do we get this income out from a fund that does not distribute dividends automatically on its own. So I have this fund over here. This is a dimensional fund. There's no reasons why I picked this fund, just that it's for convenience purposes. That is what is on my mind. This fund is from Dimensional Fund Advisors. It's available to Singaporeans. It's a unit trust, so it's available to Singaporeans in both USD as well as other currency. So as you can see over here, they put here global core equity, right? This is a fund that is based around developed markets, world developed markets, both large caps, small mid caps and small caps. So as you can see, the comparative index over here they put is at MSCI World. But one thing to note is that there's this ACC at the back. So ACC, what this means is this fund is an accumulating fund, which means that it doesn't distribute dividends on its own. It's $6 billion, and I think the current NAV is like about 29.5. The interesting thing about this fund is that it also has a distributing share class. So you can see this one look almost the same, except that instead of ACC, this is DIS. So let me back forward to let you see. Okay. So what this means is that this class of fund itself is the one that if you prefer it to give out dividends, this is the one. But the dividends is also not a lot. It's like 1% plus. So if you need more income, what do you have to do? You probably have to sell units. And I guess one thing to worry about is whether if you continue to sell units, right? Wouldn't you have less units in the later years, and then what happens after that? One key thing to note is that for those funds that actually grow pretty well over time, right? Their net asset value will grow over time. So over here, if you see this chart, right, I've actually charted out that actual fund itself. This fund, okay, this one is incepted in September the 3rd, 2008. So that's like they have about 15 years of history till today. So you can see that this is how the NAV starts off with at $10 and how it changes over time. So $10 it actually fell to $5. So this is a 50% fall. Looks very small, but it's 50% fall. And then there's a lot of turbulence over time, but generally $10 becomes closer to $30, which is 29.5, which is quite close. So you can say it went up like 200% within this time period itself. So the units do grow over time, but how do we visualize this when we want to know like how the selling mechanism goes? So I have this simulation over here. Let me try to maximize it. I hope everyone can see it. Okay, let me try to make sure that my face is not blocking. My face is not blocking everyone. Okay, so we have this simulator over here where you can see this is a starting capital. Currently, I put about $1 million lah. And we want to see whether we can spend 4% of this 1 million, which is 40,000 in the first year. Then we're gonna adjust this spending based on the last year's inflation. So in this way, you have inflation adjusted income. So we're gonna do for a time period that is that spans the duration of this fund, which is from around 2008 till 2023. So very nice. You can see the start date and end date, right? We have like about, if we count this one, that's about 16 years, or rather about 15 years of history, 16 or 15 years of history like this. Okay, so I think it's about 16 years of history. So let's go through column by column. This is the end date. So you can see it starts with 2008 till quite recently 2023. This is the actual NAV of the fund itself. So just now, if you see this chart over here, right, you can see $10 odd here and there, right? Like the full, like all the NAVs, right, at the end of September, 3rd of September or around 3rd of September, this is the NAV itself. And I've shown over here, like, what's the returns. So you can see there are some years that is like, although it just went through a GFC, actually, based on the timing of this one, only for about 14%. Now, next to it, you will see the US CPI. So this one is the reflection of like what's the inflation rate that you will adjust the income by. Okay, so if let's say the aim is you to have a real income, which means that your income to keep up with the purchasing power, right? You want to adjust the income based on CPI. So say for example, this period one, right, is 41,975. This is actually adjusted from 4.9%, so on and so forth. So you can see that the income goes from 40,000 to 56,000. Okay, now we are going to keep selling the units, right? These are the units that provide this income, like 40,000, right, at $10, right? That means that you need to sell 4,000 units. Okay, so what's left over, right? You probably have around 96,000 units. Okay, and then the value left, you take this 96,000 times this NAV, right? This is the amount over here. Okay, so what you will see is that if we start with 4% of $40,000, right, your income starts from 40,000, it starts going to 41,000, 41,000, 41,000, then 43,000, 44,000. This is quite a low inflationary period until probably the end. That's where you start seeing the income ramp up. So your 40,000 becomes 56,000. What you will notice is also that your units, right, that you need to sell to get this income, right, it goes down. It used to be 4,000. Now it's closer to 2,005, 2,004, 1,009. The reason is also because the NAV is going up. It used to be $10. Now it's $28. And so, yes, your units, you can see the accumulated unit used to be 96,000. It starts going down. Okay? Down to about 50,000. But if we look at the value left, right, 960,000, right, you end off with 1.4 million. So it's quite healthy if you take, if we, let's say we use the safe withdrawal rate, right, we want to see how much the income divided by this fund value. It's about 3.8%. So it's kind of like you're back to your starting point. It's quite close to 4%, right? Which means that this money can still, it's quite healthy lah. For this sequence, it can last pretty well. So overall, you can see for this, if you add up all together, right, you have spent about 740,000 in income. And you add the income to plus what's left over, right? There's a total value of about 2.22 million. And during this period, the NAV for this fund is like about 7.3% itself. Okay. Now, this is, I'm not using an index or something. I'm using an actual fund NAV, which means that this bakes in expense ratio as well. Okay. But it's more like, oh, I didn't buy this fund today or about 60 years ago, but I'm just traversing. What if this person buys it on September the 3rd, 2008, right? Then can they get income? And you can see that if you get inflation adjusted income and 1.4 mil left, that's pretty good. So it kind of debunks the idea that, hey, your capital will start going down. Okay. Now, you might have the question, oh, okay, it's like for the return is like about, one nice thing is the return is 7.3%, right? Can you actually spend more? So let's give it a try lah. Let's say we want to spend 6%, okay, which is $60,000, okay? So you can see, during this period, it's a short retirement period because it's like about 15, 16 years, right? Income now 60,000 goes up to 85,000. You still have 753,000 left. Okay, let's try to push it closer to the fund annualized return about 7%. Let's go up 7%. Okay, 7%. Okay, still can, but you can see that the income is about 100k, is left with 400k. I think it's gonna run out of money soon lah. So this is a little bit what people are actually afraid of. If let's say they don't know what to do, and then it's also what I'm afraid of as well lah. If let's say they decided to spend what they think is quite safe, which is, my annualized return, if let's say I see the past investment fund sheets, they say the return is 10%, so I just spend 7% lah. Instead of spending 10%, I be more conservative, I spend 7%. What happens? Okay, the income spent and the fund left, you can see it's like about 1.7 million. It's actually lesser than if let's say you just spend like 4%. It's like there is 2.2 million. So there is a certain dynamics of this. We call that the sequence of return, right? That you need to take note of to actually manage manage yourself. There's a delicate sweet spot to some of these things. Now, you might say, hey Keith, this one, okay, I get what you're talking about. This is a real examples, but this is kind of short lah. Do you have, I think, a longer simulation? I think if we want to do a longer simulation, right, we have to do some actual index simulation. So this is something similar. Okay, I hope you all can see this one. This one is a more fun spreadsheet where what you see over here, right? Instead of the global core equity fund, that one is the actual fund itself, right? I'm using a small cap value index itself. So small cap why do I choose small cap value? One thing is because I like it. Second thing is there's a lot of data, and number three is like it's kind of like, if we talk about historical returns, it's one of the most potent things out there, like potent as in damn high returns kind of thing. So there's different things that you can learn from this. So this is kind of a similar spreadsheet. The only difference is that, okay, I have a certain start year over here, so I can simulate different sequences, because I have data from 1928 to or so, right? So as you can see, you can have a black pile of shit already. You can have a black pile of shit of a lot of red color already. But let me put it to a more neutral period. Let's say 1955 or so. Okay, we still have $1 million. So the idea is, let's say if we spend 4% of it, which is $40,000, right? They have a certain returns. You can see that over here, we want to see whether we have a kind of comfortable range of a 40-year kind of retirement. It's not super short, but it's kind of long enough for you to actually see it. We want inflation to see whether you can get inflation adjusted income or not. And we have the corresponding CPI next to it. So if you see over here 1955, right? This is the CPI for 1955. 1956, this is the CPI for 1956. So we can see that this is the high inflation period over here, okay? And these are the returns of the fund itself. Some crazy returns are, you get 29%, 25%, 40%, crazy stuff lah. So that's why I like, and you can look at this stretch. This whole stretch, no red color. I don't know how much this adds up to be lah. But one thing you'll notice, let's start with 1955, right? If we spend 40,000, right, the income will eventually, because this is quite a high inflation period, right? You can see that eventually the income that is required to keep this real purchasing power of this 40,000 becomes $224,000. So that's quite a lot of income, right? But you can see over time, because the NAV also goes up. It was $10. We start with $10. At some point, it ends up with $74. At some point, it ends up with $3,000. Okay, this is not math problem lah. You can see this kind of returns is not normal lah. Okay, so but you can also see that actually the units are going down. Units is like 4,000. Like, in order to get this $218,000, which is a large sum of money, right? You only need to sell 71 units. Okay, the reason being is that each unit is $3,000. Probably in the future, I do expect at some point, like for a fund, the NAV, right, they will actually split the units, because this is too costly already. I think people would think, I have people that feedback to me that say, hey Keith, if it's like that, right, then let's say my income is like about $10,000, then how? Is it possible for me to sell just enough units, right, so that I get the income, right, and things are okay? I think for these kind of open-ended funds, we call this open-ended funds, that they can keep issuing you units, right? I should think they shouldn't have a problem next time to actually split the funds in, so that the units are actually smaller. And you can see that, let's say the value of this goes up over time. Instead of 960,000, 220 million. The annualized return is 16%. This is a crazy period. But what is also interesting is we can play around with it, and let's do some fast playing around. So some of you will say, hey, Keith, 16% return, right? I can spend 10%, right, out of this. What this means is that let's spend 10%, which is $100,000, right? Can the money last or not? You can see that after 19 years, right, they probably run out. 900K, right, is left with $49,000. So obviously cannot last lah, okay? But I don't want to dampen your enthusiasm. So let's say instead we put 1975. Do we have a better one? So you can see 1975, right, we're also spending 10% or 100,000. Annualized return is 18%. Can the money last? Can. You can see. Same $10,000. How you read into this one is that, let's say for example, right, you can invest in this fund, but the question is, right, what kind of returns are you gonna get? Are you gonna get 16% returns? Because just now remember, right, our returns is like 16%. You will say quite high, right? 16%, 16% return. 60% returns in this sequence, right? You run out of money, okay? Just slightly higher, okay? 80% return. You're spending the same income. You end up with $229 million. What are we looking at, Keith? Basically, we're looking at this is what we call the sequence of return. It is there is a certain sequence of this return, not just the returns, but also the growth rate of this income, because we're inflation adjusting this income. So at a certain point in the 1955 sequence, right, the spending, the income that is required, right, is going up too fast relative to the portfolio itself, and so it starts running out of money. Now the challenge for this is that you're not sure like which sequence you are going to get, whether you're going to get a good sequence or a poor sequence. And this one you could try jacking out because it's like about 10% already. What about 14%? See, you can spend 14% or 140,000, right? This one, you're still left with a lot of money. Can we still go up further? Let's say 16%. Still okay. Let's try 18%. 18%, you try to spend 18%. Now you have a problem already. You can spend 16%, but you cannot spend 18% of it. What I'm talking about is the first year. First year 16%, first year 18%, not 18% of the prevailing portfolio amount. Okay, 17% also cannot. 16% can. So the interesting thing is that you're not sure like what kind of sequence you're gonna get. You're not even sure whether you're gonna get 18% or not. I can show you another sequence where, let's say we talk about 1930. This is, everyone knows it's a challenging sequence. The annualized return you get is about 12%. But if let's say we just spend 6% of it, right, looks okay. It's quite a challenging sequence in the sense that you see the first 3 years, right? Usually we say negative sequence of return risk is that the first few years you have severe downturn, and you cannot adjust your spending. Your spending is still quite high, right? Then you have a challenge. So you can see at the start your 1 million becomes as low as 274,000. Now not sure like who can dare at 274,000 still spend 60,000 a year. Actually, you inflate, you adjust the income, is actually closer to 51,000 because 3 years of deflation. This 51,000 is equal to about this $60,000. But this is quite challenging lah. Which the returns of this small cap value is high, but also the volatility is high lah. I don't think a lot of people would put this as the main of their core fund. But if we're trying to use this one to actually talk around it, to share some concepts, then I think it's quite helpful for this one to actually drive the point across. So yeah, so hopefully I think people have a certain idea. Yes, you can get income. You can see selling units, you can get income. Your units actually, yes, you are right. The units go down over time. 94,000 units, right? Left with 15,000 units. But you also in terms of the amount of units that you're selling, you're also selling less units, and you're getting more income. So the dynamics of all of these things, it's working out. And we're not saying that this is just a paper exercise. This is an actual fund itself. You can see that the funds accumulated in the number of units does go down. The amount of units that you need to sell for this growing income, not growing income stream, also goes down over time. Okay, now let's go back to the slides. Let's see whether we can go back to the slide. Okay, I passed this already. So I think that's probably almost to the end of this presentation over here. I think this slide is just to actually bring you guys back to the idea that sometimes you are running you're running your own fund. You are your own fund manager over here. you have your own strategies that you want to execute and all. And look at it this way. I think at the start of this, when you're running it, you probably have some dividends that you earn from your funds, your stocks itself, right? You're probably reinvesting it or keeping it, getting ready as a dry powders to actually, so that when it's larger, you can purchase more of these individual companies. If you look at yourself as a fund manager, as a third party, right, you're not distributing income, right, for your retirement. But come retirement, right, you're probably going to distribute dividends out. But how much will you distribute? Likely, perhaps you will get maybe 40,000 annually in dividends, but some of you might not spend all 40,000 in dividends. Maybe to you, $25,000 is enough, and then you just spend 25,000. So you as a fund manager, you're practicing discretion, only like distributing 25,000 to your family and friends. I'm gonna say family and friends, family and children. And so, if you can look at yourself in a different manner, right? Then why can't you look at these funds, these funds that don't provide dividends in a different manner? So hopefully in today's video, right, you have a certain sensing. Oh, how does this work out? Like selling units doesn't mean that you cannot get a good outcome. Your units do go down, yes, but the key important thing is that you need to make sure that the NAV grows over time lah. This is a fundamentally sound fund. You can see that from 2008 till this period, I think the compounded return is about 7% or so, and so it does grow. It does grow over time. That is the important thing. And so how do you get these kind of returns? I think overall, right, the underlying stocks or the bonds, right, they drive the returns. Okay, if you are a poor, let's say you invest on your own, trying to put together an individual stock portfolios, and the stock picks aren't doing very well, right? Then you can imagine your personal NAV. It won't look something like that. You'll probably be looking something flatter. Okay, so this is what I say, like what drives the returns or what drives the dividends or the payouts, right, is the underlying. You're so focused on the underlying. What all this means is that you have these accumulating, you have these funds available for you, right? Just focus on the total return. When you're picking out a fund manager or what's the strategy to use, right? Focus on the total returns. Don't just focus on whether this fund actually provides an income or not. If they don't provide income, make sure that I think it's liquid enough, because like some of the accredited investor funds, they will have some lock-in. You cannot get liquidity so easily. So that becomes partly a financial planning problems. But aside from that, right, if it's a retail fund that doesn't pay a distribution, right, you have the control to actually decide how much income you try to get out of it, how much to actually extract so that you don't run out of money, right? That's what I went through in the safe withdrawal rate video, and I'll link some of these videos that I mentioned in the past in the descriptions below, so that you can watch them again. That video would probably explain it's like the sweet spot between trying to make sure that you have enough money to spend but don't run out of money, and then what's the kind of asset allocation. And probably if you have more questions, we'll just leave it in the comments. We'll talk more later. So that's it for this video. See you in another video, and if you like this, do share with your friends and we plan to do more of this in the near future. Okay, bye bye.